Good afternoon, ladies and gentlemen. Thank you for having me this afternoon. I hope that this presentation can add some value to your decision-making processes and give you some insight on how to better interpret economic numbers and statistics. When I was asked to talk about this particular topic, a quote popped into my head, and I'm sure when you guys see this topic, it would have popped into some of your heads as well. And it's a very famous line that says that there are three kinds of lies. You get lies, you get damned lies, and then you get statistics. So statistics have gotten a very bad reputation through the course of time. Note also that this is a very, very old saying that was already, or statement that was made in the early 1800s by then Prime Minister Benjamin Disraeli. It's important to point out that when you think about why statistics might be viewed as lies, is that ultimately the numbers and the statistics do not speak for themselves. They are open to interpretation. And the way in which the numbers and the data get interpreted are subject to any personal biases, ideologies that the interpreter subscribe to, and therefore, whenever you get exposed to any data or statistics in the media, especially, you need to read it with a healthy dose of skepticism. You need to look at the numbers, look at the data, try and understand for yourself what's going on there rather than just digesting it the way that it's being presented in the media. One of the most popular statistical indicators that get monitored, not just in South Africa, but across the world, is, of course, the infamous GDP numbers. There is often a hype around any economic data that gets released, and in South Africa's case specifically, there's always a fear about the country slipping into a technical recession. But what is a technical recession? What does it actually mean? Now, in economic terms, a technical recession is 2 consecutive quarters of contracting GDP. How do we view South Africa's GDP? It's viewed on a seasonally adjusted, annualized, quarter-on-quarter rate. So it's very difficult to tangibly understand what that means. What is GDP? So if we look at the way that GDP is calculated, the methodology that is used is called the gross value add methodology. And what this does is it measures the value of an output or a final good minus the value of the so-called intermediate goods that were used to calculate the GDP number. There are many flaws in this methodology. Unfortunately, it's the most widely used and widely accepted measure of economic activity, but it nevertheless fails to capture a lot of what is going on in the economy. For lack of a better measure, it gets used by government to make decisions, for example, in the budgeting process. It gets used by the South African Reserve Bank when they take decisions on monetary policy and interest rates. And what I want to do today is also just try to give you some alternative measures to look at and to digest and to understand a bit more about the business cycle. When we analyze an economy, the first thing that we want to know is what is going on with the money supply. The money supply provides a wealth of information around what dynamics are like in an economy. It shows us, or it tells us basically what the cash as well as credit dynamics are like in the system, and it's very important to understand specifically what the credit dynamics are like. If we look at the monthly money supply data that gets released by the SARB, and in fact was released this morning, alongside that number, we also get the private sector credit extension number. Now, this is essentially just the credit that's being extended to the private sector, and it's broken down into households and corporates. When we look at corporate credit extension, it tells us a lot about what sentiment is like in the business environment. If businesses are not confident about the future and they're not confident that it is worth their while to take on credit, to invest in their business, expand their business operations, that they will be able to sell their product in the future, they will be very reluctant to take on credit from the bank, especially since they have to pay an interest rate to get access to that credit. In terms of households, for example, the inclination of households to take on debt tells us about what their budget dynamics are like, and it also gives us a sense of what consumer confidence dynamics are like. Let's look at, for example, or consider general loans. Some of you might recall a few years ago, there was an incident with Africa Bank where the SARB had to bail out Africa Bank, and this was the result of South African households or South African consumers that took on more debt than what they were able to afford to pay back. In an economy like South Africa, often we see that general loans, which are also referred to as unsecured lending, is used by households to supplement their budgets. If they're not able to get by from one month to the next with their budgets, they tend to access credit to meet their consumption needs. This is an unsustainable model, and at some point, something's got to give. Another component in household credit that we can look at is mortgage advances. This gives us a sense of whether households are willing and or able to take on loans to invest in durable goods or assets such as houses. So this is some of the details that we look at in the money supply data. And while I've discussed some of the demand side dynamics in terms of household and corporate appetite for debt, there is another side of the equation as well, which is, of course, banks and their propensity and ability and willingness to lend money into a market. And this will tend to be determined by whether or not these banks are able to appropriately price for the risk that is associated with extending credit into a market. Now that we've looked at the money supply, there is an alternative indicator from GDP that we can look at to get a sense of what overall economic activity is like. And this indicator is constructed by the South African Reserve Bank. It's called the SARB leading indicator. When we look at a GDP number, if growth is expanding at 0.2% or 0.5%, it doesn't really tell us all that much about what the environment is actually like at the moment. If we pull back the lens a little bit further, and we look at the leading indicator, which considers a number of indicators that are both real economy indicators, such as money supply, passenger car sales, and then also some financial market indicators like the interest rate spread, for example, the cost of interest rates in both the short term and the long term, as well as several other indicators, as you can see there. It gives us a sense of what the cycle dynamics are like in an economy. In South Africa, we also need to understand what the different economic sectors are doing at any given time. The GDP measure, which although it is flawed, does provide us insight into these different sectors of the economy. We've got the primary sector, which is made up of agriculture, mining, productive sectors. Secondary sector, also productive sectors, which includes construction, electricity and manufacturing. And then the tertiary sector in South Africa's economy is the services sector to a large extent. What we can see from this composition of GDP is that our primary and secondary sectors do not make up a very large proportion of the economy. This gives us some insight into South Africa's ability to produce goods that we can export to the rest of the world. It also gives us some insight into the labor market dynamics in South Africa. The primary and secondary sectors tend to be sectors that are typically employ your lower skilled workers, whereas the tertiary sector, such as, for example, finance and business services, tends to employ your higher skilled workers. So we can see here that the South African economy at the moment is being driven by the tertiary sector, and the primary and secondary sectors are under a bit of pressure. If we are not producing a whole lot of goods, it means that we don't have a whole lot of goods to export to the rest of the world. At the same time, there are needs for consumers, and these needs ultimately find expression in their consumption demand. If we look at a country's trade account balance, which is the next indicator, we get a sense of what the country is consuming relative to what it is producing. If you are consuming way more goods than what you are producing, it means that there's a shortfall in terms of the financing that you have to pay for the goods that you are consuming. And this finds expression in a deficit on your trade account. Why is it important to understand whether or not the country is running a trade account surplus or a trade account deficit? If we are running a deficit on our trade account, it means that we are not generating the foreign exchange revenues that are required to pay for the goods that we want to import. In such an environment, it means that you have to find additional dollars to pay for the goods that you're importing, and that tends to exert some pressure on your currency. So if we look at the trade numbers, if South Africa is running a trade account surplus, that kind of environment tends to coincide with a relatively more resilient rand, whereas an environment where a country is running a large trade shortfall, it means that the rand is perhaps a bit more fragile. It also means that the country is exposed to external shocks. The trade component makes up quite a significant proportion of a country's current account balance. So the current account considers the trade of goods as well as services, and then also income and transfers. The same logic that applies with the trade balance applies to these other components in the current account, and ultimately it can be viewed as a bank account. If you are constantly in an overdraft, you're doing something wrong. If you want your business to be resilient to external shocks, you ideally want it to be balanced, your books to be balanced. The same principle applies to a country. If you're running a large shortfall on your current account deficit, it means that you are maybe not doing what you're supposed to be doing, and it leaves you vulnerable to external shocks. The next component, or the next indicator that we're going to look at, is fiscal dynamics. Extremely relevant for South Africa at the moment. The fiscus, it's often referred to, or it's basically just the government budget or the fiscal deficit. Now, South Africa has been running a very imprudent budget for quite some time now. Simply put, the government has been spending way more than what it should be. And given that the economic environment has been as challenging as it has, it's been increasingly more difficult for the government to extract revenues from the South African economy. What's happened through the course of time is that we've had significant mismanagement, corruption at government level, and this has really hollowed out the budget shortfall. Now, in an environment where you are running a shortfall in your budget, it means that you need to finance that some other way. If you're not able to extract the revenues from the economy, you have to finance that deficit some other way. And the way that South Africa has been doing it, of course, is through taking on more and more debt. In the past roughly 10 years, South Africa's debt to GDP ratio has increased from around 24% to levels that are close to 60%. Why is it a problem if a country takes on more debt? Several reasons. One of the reasons, the more debt you take on, the more fragile the system is, the higher you have to pay or the more you have to pay to actually access credit. And that is reflected in the high and rising yields on South Africa's government bonds. So as the government takes on more and more debt, they're being forced to pay more to service the debt, and that then eats into their expenditure component. How does this impact businesses, or the influence that it has on businesses? is, of course, through South Africa's credit ratings, which I believe will be discussed extensively after the session. But this chart shows us how South Africa has really not been prudent in the way that it runs its fiscus, and the result has been several credit rating downgrades through the course of the past couple of years. Note that this is something that did not happen overnight. This has been a long time coming. If we do not address the current debt to GDP trajectory, South Africa will find it very hard to avoid further credit rating downgrades. What does a credit rating downgrade mean for business? In an environment where the government has lost a lot of credibility, you tend to see that corporates are influenced as well in terms of their ability to access credit, and it is typically also much more expensive for them to access credit. In an environment where your government is as fragile as the South African government is at the moment, it creates a lot of uncertainty about the future, and that makes it difficult for business to access credit. With the government having ramped up debt as much as it has, and increasing taxes as much as they have, we have gotten to a point where the private sector has essentially been crowded out of the economy. And the way that we can see this is by looking at private sector investment as a percentage of GDP. Now, private sector investment is captured as gross fixed capital formation in the current account release that we see quarterly. And what this essentially shows us is that South Africa has really seen a big shortfall in terms of business investment into the economy. It explains to us why the mining, manufacturing, agriculture sectors have really struggled to gain any significant traction. It shows how the resources that the government is extracting out of the economy, and those resources, or the capital that's being deployed in a very inefficient way, has a cost for the private sector. So this just offers us some perspective on our fiscal debt trajectory, and again, it shows us that there is a price to pay for government mismanagement. Another key indicator that we look at is the unemployment rate. What this shows you is the expanded versions of unemployment. The official unemployment number is around 28% odd at the moment, but you can see from this chart that the real levels are actually much higher. The reason why we have such a high unemployment rate, it relates to the previous slide where I showed you how investment has just been falling off a cliff. The government's been crowding out the private sector. And this is really important for South Africans from a budget perspective as well. In an economy where you've got high and rising levels of unemployment, it means that the tax base is shrinking. It means that the government has a smaller pool of money from which they can extract revenues, and it means that they will probably increase taxes further in order to finance their spending needs. They can finance spending two ways, either through increasing taxes or through taking on more debt. So this just gives us some context as to why the situation, or the fiscal situation, is quite pressing at the moment. It's also important to note that the high and rising levels of unemployment is a function of a failing education system as well. If you are in an economy that relies quite heavily on the tertiary sector, the services sector, but you are simply not able to generate the kind of skills that are required for that sector, you will see the unemployment rate increasing. Our laws in terms of allowing skilled immigrants to enter the country also factors into this, and a combination of these dynamics obviously have implications for the fiscus. Right, so the next key indicator that we look at is inflation. Inflation is also one of the key metrics that most people are familiar with. Technically, it measures the rate of price increases of a basket of goods from one year to the next. But what does it mean for a business? If you're operating in an environment where the rate of inflation is fairly stable, it is much easier for you to plan around your business. If you are operating in an environment where prices are extremely volatile, it's very difficult to plan for the future. High and rising levels of inflation tend to eat into profit margins through various methods, through rising input costs, through pressure in terms of wage increases that employers have to give to their laborers. So monitoring the inflation rate is very important. How does inflation work? How do we get to the inflation rate that we do? Inflation and the rate of inflation that can materialize in the economy has a lot to do with money supply as well. The amount of money that's in the system will determine the rate at which prices can increase. And for that reason, it is very important for a reserve bank to be extremely prudent in how they go about setting monetary policy. The SARB has been on the receiving end of a lot of criticism lately, given that they haven't bucked under political pressure to aggressively lower interest rates in a bid to stimulate economic growth. Why is that thinking flawed? Why will lower interest rates not save the South African economy? The fact is that South Africa is dealing with a lot of structural issues. These structural issues include the massive fiscal deficit that I pointed out earlier. It includes the high and rising levels of unemployment. It includes very low skills. It includes falling investment. The SARB cannot fix those factors simply by lowering interest rates. If the SARB does decide to lower interest rates, they buckle under political pressure. They risk creating an environment where price increases can accelerate significantly. We can look at an extreme example, which would be a Zimbabwe, of what can happen if a bank just lowers interest rates and opens the printing press. But that's your worst case scenario. And at the moment, it seems as though the SARB is not going to go down that road. The SARB has matured in their inflation targeting framework through the course of recent years. We can see that the inflation rate's deviation from the 4.5% midpoint target has shrunk significantly. And through the course of recent years, the inflation rate's been very close to that 4.5%. And that is a function of the SARB being quite prudent in the way that it sets monetary policy. Real interest rates have been positive for the better part of the past couple of years, which means that the repo rate is higher than what the inflation rate is. And this means that households and businesses are to some extent disincentivized to take on credit purely for consumption purposes. A stable inflation environment and a relatively stable interest rate environment is conducive to businesses doing a better job at planning, budgeting, and so on. So therefore, even though central banks are typically not particularly popular in the Austrian school of thought, the SARB has been doing quite a good job in terms of how they've gone about setting monetary policy. To bring this all together, I went through quite a few indicators. It's difficult to try and give an economics crash course in such a short period of time. Ultimately, the data that we receive represents millions of people's, businesses, decisions that are being made on a day-to-day basis. The way that the data and the story is interpreted is subjective. So if you want to be better equipped to interpret the data, it's good to do some of your own homework, go read up on Austrian economics, the way that it's viewed, the way that the thinking around economic data differs from the Keynesian methodology, and create your own story around the data with that background. The metrics that I would recommend monitoring include the money supply and credit numbers, leading indicator, trade and current account balance, the fiscal deficit, fixed investment, unemployment, inflation, and then finally, interest rates.
Hartlike welkom by Sakeliga. Sake wat? Goeie vraag. Ek sal verduidelik. Sakeliga is eintlik baie eenvoudig. Dit is 'n markplein aanlyn. Lys jou besigheid, lok nuwe klante, kry sakevennote, kom bymekaar in sakekamers en nog baie meer. Om te sien wat Sakeplein en sy mense vir jou kan doen, registreer vandag jouself of jou besigheid op sakeplein.com. Sakeplein. Skep waarde, maak wins.